All right, we are back with Gareth Soloway, Chief Market Strategist of In the Money Stocks and Master Trader at Verified Investing. Once again, we have a lot of action and activity to talk about. Gareth, how you doing?
I'm good, Greg. How are you doing?
Doing great, man. Doing great. We've got a lot of action with Bitcoin waking up on the ETF pending now that what seems like the 99% pending approval first week of January, second week of January, it looks like. Is the window for that. And then the markets have been on a tear in spite of Jay Powell coming out and saying, hold your horses, we're not there yet. So what are you looking at, man? What's going on?
Yeah, so I think the key over the weekend here, and it started on Friday, was when Bitcoin broke the key 38,000 level. So if we take a look at the chart on Bitcoin here, Bitcoin had been hammering on this 38,000 level multiple times. In fact, just in the last week, 1, 2, 3, 4, 5 times in about 8 days or so, finally broke through. Now the question is, can it get through 40? So if you look at the high from the weekend, we got almost to 40,000. That psychological even number will be a little resistance. I actually still think it probably has a little bit more upside going into the end of month and the approval. The big question, I think, and this is the big disagreement, and I'm curious to hear your perspective on it. I'm in the camp where I think there's a lot of front loading here on the Bitcoin spot ETF, meaning that people are buying on anticipation. And when that actually gets approved, I think you'll get an initial reaction, which will push it higher. But then I actually think that will be a short-term top on Bitcoin, and it probably pulls back to around the 30 to 32,000 level. So I was kind of curious as to your thoughts on that. Like if you're thinking, no, it's going to continue to run, or what your thoughts are there.
Yeah, I think it's going to continue to run. I think if we get a pullback, I'm surprised we haven't seen one yet, but I think if we do get one, it's going to be before the approval sometime in December, especially if markets pull back significantly. I think Bitcoin and crypto will follow suit. Maybe 10 to 20%. But to your point, there is technical support for what you're saying of a 20 to 30% pullback after it hits 40, maybe even 45. If it gets to 45, that's your 786 retracement from the peak to the bottom, over the last couple of years. So you could see it get as far as 45 before you get any significant pullback. But I'm kind of thinking you might get a little something in the markets here in the next few weeks ahead of Christmas, so you can get that end of the year Santa Claus rally. And I think Bitcoin will kind of follow along with that. The interesting thing about Bitcoin is, so if the ETFs get approved, all of this is ETF driven, right? That's what's driven this price action over the last month specifically. And there are a lot of people front loading, but the big money and the patient money is not front loading yet. And so what we're looking at in January is that 19B approval, which gets everything ready and set up for those funds to actually activate. So they're not going to activate in January, which doesn't matter. The retail hype's already there. People are getting in ahead of it. But the thing that I think is going to keep price higher for longer in Bitcoin is going to be when the institutional investors, the life insurance companies, the pension funds, hedge funds, the 401ks, when they start allocating to the ETF, I think that's going to be your patient capital that is never going to sell. That's going to be the dip crowd that's going to put that ultimate floor in Bitcoin, I think, for the longer term and drive that price potentially exponentially higher. And
Do you think the spot ETF, though, is that trigger where all of a sudden these pension funds are going to feel like it's okay to invest in Bitcoin? Because I'm still a little skeptical that it's going to come in that quickly. Like I do think over the next few years, the pension funds will slowly start to allocate. But for me, I look at it and we just had CZ getting basically arrested and jail time is probably coming there. We've had FTX. I mean, do you think when you're dealing with these people's retirement that they're going to really be like, okay, now this spot is approved, we're going to allocate right away?
So it depends so endowments are probably going to be the last to the party. I think life insurance funds can be a little bit more entrepreneurial. Pension funds can be a little bit more entrepreneurial, but some of your big money are endowments. And I think they're going to be the last, to the party there. But all of those are probably 0.5% to 1%, of an allocation that they can go ahead and risk it. Because a lot of them are still playing catch up. Even as much ground as the markets have made up, a lot of those funds are still behind. They have dividends to pay, they have premiums to pay, they have pensions to pay. So they have to generate yield. And then, the people running those funds have to make bonuses and they have to make money. But I think the big money is going to come in from 401ks. I think there's a lot of retail investors and there's a lot of money managers out there, wealth managers. They're going to be telling their clients, look, you have to allocate to this space. And I think that's going to be a bigger allocation. I think you're going to see a 5% to 10% allocation. And, I think 401ks and IRAs, I mean, 30, 40, 100 trillion, something like that. I mean, that's a significant amount of money out there. So a small allocation from that could drive price action. I think that's where you're going to see the real FOMO is at the retail from the 401k and the IRA.
Yeah, and I agree with that. I think that money managers or advisors that have been obviously reluctant to push Bitcoin, they probably do start to. And I do think there's a significant amount of money there. I do wonder, and this is kind of my only bear case left of potentially seeing 15,000 again, is, if we were to see a 50% drop in the stock market, what does that look like for Bitcoin? And for me, the panic that would ensue by markets being down that much. I mean, we saw it in 09. That would probably cause significant risk adjustment, even in crypto and even in Bitcoin, even deleveraging. I mean, I also wonder, and this is another question that I don't know necessarily about, but I have a feeling there's a lot of leverage, at least in the retail side, being put on Bitcoin right now.
Yeah, there's a lot of leverage
just
out there in the space.
Yeah.
And then with the ETFs, that's going to allow more leverage because now
Right.
you'll be able to leverage there, where a lot of these other funds, aren't able to use leverage, that aren't trading spot. They're not using that vehicle right now. To your point about the markets, yeah. So again, it's a risk asset. Even with the ETF, it's a risk asset, right? So yeah, it's going to follow markets. You get a big sell-off in the market, you're going to get a sell-off in Bitcoin, just like we saw in the pandemic, just like we saw 08, 09. The question is, are we going to get a big sell-off in the market? Because the markets have been fighting the Fed this whole way,
right,
since the bottom in October of last year. And, it doesn't matter what the Fed says. The markets are like, nope, you're going to have to cut rates. No, we don't believe you. And the markets have been on a tear, pretty much the whole time. So, is there going to be, any kind of significant pullback in the markets? Is there a chance the markets could sell off because the economy's strong, jobs are still good, retail sales came in strong, inflation's coming down, with gas and some of the other areas. Now, we still have, record unaffordability in housing, record unaffordability in vehicles and autos, things like that. But what you don't have to see a market crash, to see a panic, is you don't have job loss. I mean, that's what a recession is, job loss. And we don't have that. We don't have any signs that we're going to have that.
And I think that's the big kicker, right? Is that, the markets, interestingly enough, the run we saw basically from the beginning of November on the S&P 500, and it really an incredible run, historic run, almost one of the biggest moves on a monthly basis, about basically 12%. That's coming on the back of all of a sudden this risk readjustment of essentially expectations of the Federal Reserve, right? If we look at the 10-year yield, topped out, and that's exactly when the bull market run that we saw in November began, right? I mean, you can literally line up the date almost perfectly. As yields have collapsed here, that's when them driving the markets up. Now, my question is, and coming into year end, and I think you alluded to this as well, which is, do we see a little bit of a pullback in the markets? And you're getting to a point where, in my opinion, I think you've seen a little bit of an overshoot, right? I mean, to see an 80 basis point, actually more than that, we were at almost, a little over 5%, but we've seen an 80 basis point drop in the 10-year in really a very short amount of time. I mean, bonds historically, and you've been around for a while like me, these moves continue to be very abnormal. And so if you did see, all right, so a little bit overdone on the drop in the yield, if the yield bounces back, let's say to 4.4, 4.5, then it would give the markets an excuse to probably sell off a little bit.
Yeah, the bond market's been fascinating to watch over the last year. And, Bill Ackman, I mean, a lot of people say he single-handedly moved the bond market when he called, his shorts were off. And, it's been off to the races ever since. The 2 years been on a run. The interesting thing with the stock market is, again, it's pricing in all these rate cuts by the Fed because the markets, they just don't believe the Fed. The markets are saying you're going to have to cut rates for whatever reason. And I don't understand what that reasoning is, because the thinking there would have to be there's going to be weakness in the economy to where it's going to force the Fed to cut. But the Fed's going, look, the economy's strong, jobs are strong, sales are up, inflation's down. We're not cutting. And Powell came out and said it's premature to even think about it or talk about it. But the markets are like, yeah, so what? I mean, they rallied just right after he said that.
I think that was fascinating to me because he was pretty specific in keeping expectations for cuts off the table at this point, basically saying we're not even going to talk about that. But the markets basically called his bluff, right? I mean, they basically said, nope, we don't believe you. And in all fairness, I mean, there were probably like 15 Fed speakers last week. And probably about half of them brought up the potential for cuts, and the other half kind of talked the other side. So, again, it's one of those things where the market will believe what it wants to believe in the near term. And then we have to see if things get overdone in one direction too much. And again, yeah, I mean, the dollar's been on also a historic drop here. Just going back to that same period, you've had this drop in yields and the dollar. And yeah, I mean, that has really helped fuel this stock rally that we've seen, and really gold too. I mean, gold's kind of been, it's starting to be talked about more and more. We finally hit that quadruple top now. And again, for those of you that know technicals, once you hit 4 times, usually the 4th or 5th time you break out. And so it'll be interesting to see on gold if we can finally break out and maybe get above 2,100 into year end.
Yeah, it's fascinating, and I'll tell you, what's really interesting, about this whole thing, especially with the markets and the Fed. You go all the way back to 2009, the bottom of 2009. We've had all this, zero interest rate easing and all that. We had no inflation, really at all, hardly, for that entire time until the pandemic. Because of that supply side situation is what really drove inflation. We just couldn't get things, so that's what really, drove inflation, has continued to drive it. And now we haven't seen any real consequences of higher for longer. I mean, we've had the highest rate hike we've seen in the history of rate hikes, and we really haven't had any negative consequences. We had a little bit of banking issues, but they put some vehicles in place for that. That wasn't even a crisis. It was just a little hiccup. We've had zero repercussions. And what's really interesting is, the way the markets, are responding to everything that the Fed has said and everything the Fed has done, because we had the whole situation with rates shooting and peaking, like you said. That did all the tightening for the Fed. Now financial conditions, and this is what I think a lot of people are not looking at and thinking about, is that now it's the other way around. So the financial, with the rates down, the dollar down, like you said, that's easing financial conditions for the Fed. So the Fed doesn't have to cut rates. They won't cut rates because financial conditions have eased significantly, just like they tightened significantly on the way up. So the bond markets and the dollar are kind of doing the work for the Fed.
Yeah, it is interesting to watch that happen. It happened on the other side too, when, I still remember Powell a few months ago coming out and basically saying, rates had adjusted to 5%, and that essentially did the work for the Fed, so then they could back off. And then that ultimately kickstarted the cut thesis, which then has adjusted them back down. And it's interesting. It'll be interesting to see where rates settle out here. And I do think that there'll be a point probably where rates find this middle ground, maybe 4.25%, maybe 4.5%. But then the bigger question comes, and I don't know if you're on this side that I am, but I do think that we're still going to get at some point a hard landing. Like, I still think there will be some sort of recession. And if that happens, then where is inflation at that point? Everyone's thinking inflation's going back to 2%, the soft landing or no landing at all scenario is happening. I'm not convinced of that. I still think that there's pressures in the underlying, whether it's in the payroll side of things with paying people and so forth, that are going to keep inflation elevated. And, again, I'm not saying elevated to 5%, but, technically the mandate, they said they want 2% or less. I don't think it's going there anytime soon. I would think 2.5% to 3% is probably your low end. And then the question is, what does the Fed do? Can the Fed cut back to 2% if we get in a bad recession on the Fed funds rate?
Yeah, that's the thing. The Fed can't do anything right now because inflation is still a risk. And to your point, I don't think we'll get below, if we get below 3, 2.8, 2.9, twos, is their target. 2% is their target. So that can be 2.9995, right?
Right.
So I think we're going to be high twos if we get there in the way they measure it. Now, you and I know real inflation at the consumer level on the streets is probably still 8, 9% when you look at food, clothing, shelter, automobiles, all the things I just talked about. Even though prices are down, what a lot of people are missing is the rate of inflation is down, but we still have inflation. Prices are still up and they're still climbing. So what I'm seeing, what the market is seeing, and what my thesis has been, is that wages are rising to meet that level of inflation, to the point to where it's kind of offsetting a little bit and working itself out, kind of like house prices. We saw 10 years of appreciation in 2 years. Wages are kind of rising to catch up with that appreciation. The house market's kind of stalled. You're seeing prices come down and price reductions, but those are off of very distorted levels. Right. So you got to go back to pre-pandemic. Where was it normally coming off of these, regular years of appreciation? We're still well above pre-pandemic levels, even in the biggest housing markets that have corrected, like Austin, Texas, Phoenix, things like that. Then when you look at Other things like automobiles, kind of the same thing. Prices are coming down in the luxury sector and all that, but you still have cars. I mean, I saw something the other day, one of the big Twitter accounts, car dealership guy, was posting, Escalades are still selling above MSRP. And,
Amazing.
Tesla coming out with the new Cybertruck, and that's selling for more than what he's talking about.
Yep.
We'll see how that ends up. But what I'm looking at, what I'm thinking is the way it's looking right now, because the job market is still so strong, there's still more jobs than there are people willing to take them. GDP is still growing. Retail sales are still strong. What I've always said is that Q4 this year and Q1 next year, we're going to have our answers. We're going to know where the consumer stands. We're going to know where the economy stands, because all of the bills are coming due. And people are, they're out there with that revenge spend, with that doom spend, where they're like,
Yep.
you know what? I don't care. I'm tired of hearing about it. We're just going to enjoy the holidays. We're going to have fun. They took their vacations coming off the pandemic. They had that, pandemic spend and that, cabin fever spend all through the summer, through the fall, the holidays. We still have moratoriums and vacations on student loan payments. There's a lot of forbearance out there still in the mortgage markets if you're behind on your mortgage. So anybody listening, if you're struggling on credit cards, mortgage, or car payments, all you have to do is call them and tell them, and they will extend that. They will give you a couple extra months. You don't even have to show cause. All you got to do is just ask. So that stuff is still going on. That's kind of kicking the can down the road. But, some of that I think is going to end coming into next year. And, eventually the bill has to get paid. So I think that's where we're going to start to see a little pressure on the consumer pulling back on their spending, Q1 next year. The question is, what is the real result of that? Because again, people are still employed. As long as people are employed, they're going to keep spending money, and the economy is going to keep growing, and prices are going to stay where they're at, because why should you lower your prices if people are still buying your product?
That's right. Yeah. And I think the big thing that I'm looking at is into next year, the battle between the markets, right? So if we head into a recession, the battle will be waged between earnings per share decreasing, potentially the multiple, going up on the market just by the recession itself, versus the pressure of lower Fed rates. Like if the Fed starts to cut, so Fed cutting would technically, you'd assume it would push the stock market up. But then if you're in a recession, you ultimately have the multiple issue, which again will be a battle between those two, which one ultimately wins out. And that'll be interesting to see. Again, I'm more in the camp of, if the market views the Fed as being somewhat handcuffed, like let's say they can cut a little bit, but the recession is a little bit worse, or people start to worry about that, then you have a stock market potential for a bigger sell-off.
Yeah, and this is to your point. A lot of people so there's two theses. One was we weren't going to see, previous all-time highs or new all-time highs for years because of that reason. Inflation is too high. The Fed can't do anything. So if the economy does tip into a recession and you get job loss, again, a recession is not negative GDP for a couple of quarters. And the recession is like we saw in 08, 09. You had an industry that got wiped out, housing, which was a huge part of the economy. You had job losses at scale all over the place because of the housing. We don't have anything right now that can do that. There's nothing out there right now that's going to create job loss at scale like we saw 08, 09. There wasn't even a recession in 2000 in the dot-com bust. That was just speculation. So what you need job loss at scale in some industry that affects the overall economy. That's going to be housing. That's going to be manufacturing. That's going to be, maybe the financial sector if there is issues behind the scenes with banks that we don't know about.
Right.
So and then there, of course, there's geopolitical risks that could create some sort of a World War III that would create an initial sell-off in markets, but not recession.
In your view, is there a risk that the U.S. debt, let's say by next year, is at 35 trillion, and we've been seeing these bond auctions that have not been going off great? I mean, again, I think demand came back a little bit in a couple last week just based on rates falling. But for the most part, someone still has to finance the U.S. debt, right? At some point. Is there a point where these other countries say, hey, no, we want a higher interest rate, and that can potentially take the power away from the Federal Reserve to cut? I mean, if the Fed can cut all it wants, but if no one buys our debt for anything less than, let's say, 6%, then rates are going to probably be up around 6%, right?
You would think so. And several people were calling for that back when rates were hitting 5.5%, but we didn't see that. There was still a good appetite for our debt around the world. And, you got to remember, at the end of the day, the Fed can be the buyer. So the Fed can monetize the debt. So I'm not sure the debt matters in the short term or even the long run from a monetary, modern monetary theory standpoint. And so far that experiment has held true.
Right.
I'm just
It's
not
hard to
sure.
imagine it's not going to matter in the long run. I can totally understand the short term because the narrative being spun right now is soft landing, no landing at all. So the U.S. economy is going to be strong and everything's going to be fine. And, okay, the debt's going up, but the U.S. is going to be strong. But, at a certain point, if the consumer does start to pull back, at some point, yes, the Fed can be a buyer, but then you start to lose the credibility of the US dollar potentially. Granted, it's still a reserve asset. I mean, it still is the reserve currency, but I just could see, and again, I don't think what I'm talking about is something that happens in the next couple of years, but it does make me wonder later this decade, if this debt continues to not be dealt with from a governmental point, is there a reckoning day essentially?
I guess that depends on the strength of our economy. So I think it's all tied to that. As long as we remain the number one economy in the world and we remain the biggest consumption economy in the world, I think we can support that.
Right.
And I think the Fed can monetize it. And I think it just doesn't matter because it's just checks and, it's just checks and balances. It's debits and credits. So the rest of the world doesn't care. Again, if I can, if I'm the guy that can lend you infinite amounts of money, or borrow infinite amounts of money from you because I can continue to pay that interest rate, are you going to continue to buy that debt and continue to lend me money? If you know that I can print money and pay you back and my economy's strong and I'm the biggest dirty shirt in the laundry out there, you're going to continue to buy that rate because you need yield. You need somewhere to park your money. If you're a country, there's only so much gold you can buy. You got to park your money somewhere because it's the deepest, most liquid market in the world, and you've got the biggest buyer, the biggest 800-pound gorilla in the room in the Fed that can just infinitely buy the debt, and it doesn't matter. So I'm not saying I subscribe to that theory. I'm just saying that's what's been playing out.
That is what's been playing out. You're right on that. And I think that's going to be the big thing. And that's what most people are banking on, is that it can continue. So yeah, you're right. In a way, you have to go with that thesis until it's proven otherwise, until there's cracks that emerge. But I do think it's important for all of us to remember that, the thesis in 2007 was that everything was going to be okay. And then it crumbled in a matter. I mean, it literally crumbled overnight. And we saw that in The Big Short and some other movies that were kind of replays of that. So it'll be an interesting time, man. I think this week, looking ahead, we have the jobs report on Friday. That's going to be huge. There's a few other economic reports in there, but it's a time where let's see if interest rates continue to dip.
So let's qualify all this and talk about the two theories out there. There's the melt up theory, to new exponential all-time highs, then a big bust in a multi-year, bear market. Then there's, the theory that we're going to see, some sort of a recession, some sort of a, meltdown for a while and maybe a longer term bear market. Then here's what the economic data is just showing right now. It's a soft landing or no landing. We still have good economic data across the board because jobs are strong, people are spending, things like that. And we're just going to continue to kind of sail in and everything's going to be, fine and hunky-dory just because, things are humming along so well. And because the Fed and central banks have these tools like that, that I can't remember what it's called now, the BTFP program that they put in place for the banks back when were having liquidity problems. We're seeing the RRP drain, which is putting liquidity into the markets. And I think there is a ton of liquidity, but your biggest 800-pound gorilla supporting markets is that 401k IRA buyer, hedge funds, pension funds, investment funds that have to make dividends. They have to get their bonuses. They have to earn yield. There's just so much liquidity out there that has to be put to work. And there's hundreds of trillions on the sidelines still waiting to enter the markets. So where are you with those three theories? Melt up into into next year sometime, then a multi-year bear market, a big sell-off coming maybe this year, and then, some sort of a event, or we just kind of continue to sail on and just cruise and surpass all-time highs and just kind of keep going.
Yeah, I'm so the one I'm most skeptical on is just that we're going to keep going to new all-time highs. I think for me, looking at the data that's beginning to emerge, and this is data that's kind of under the rug right now. It's the markets aren't really paying close attention, but it would be stuff like new home sales down 18%. Some of the data coming out of the retail consumer with credit card debt continuing to expand. I think that during COVID, people got addicted to spending a lot of money because they had a lot of money, and I think that's continuing. And I think that at some point, the consumer, and it might be after the Christmas season, I could totally see people saying, you know what, let's just have a great Christmas and then we'll cut back in 2024. But, different little things, these underlying things, to me, they're cracks in the glass or in the ice, right? And at some point, those will have to play out and start to be a contagion factor for the bigger market. So it's not to say we couldn't, at this point, it's always possible we retest those all-time highs. I think almost in a weird way, it almost would make sense to kind of flush out the maximum amount of bears by going back and making everyone really believe it. But I also think that you're getting to that max point of the VIX is now at levels not seen since 2009. The complacency out there is becoming, something that is definitely, I'm taking a note of it as well. And so for me, yeah, I think that you could easily make a run at those all-time highs, but I'd be surprised if we really just continue on our merry way to the upside without seeing some sort of recession next year. And I do think, if we look back in 2007, if you look at the data, it was strong jobs, slightly weaker jobs, and then fall off a cliff, and I do think that in past bigger recessions, that tends to be the way things play out. Like everything's fine until it's not, essentially.
Yeah.
And so
we are seeing some signs of weakness out there. I mean, you're seeing fast food, McDonald's and Burger King's closing. When you see McDonald's close, there's something going on. And it's because interest rate, it's because, wages are up, food costs are up, and their rents have not come down.
That's right.
Rents have continued to rise. So there is pressure out there. So
yeah, even in my area here, in fact, I was just, I've seen more closings. Boston market closed in my area. There's been more and more closings going on. And again, it's, at this point, it's nothing to raise an eyebrow at maybe, but it's something to take note of. Absolutely.
Well, another one too is keep an eye on Chick-fil-A's. Chick-fil-A's are strong no matter what. You start to see, lines diminish at Chick-fil-A, something's going on.
True.
But I think Q1, the bills are going to come due, and we're going to see, where people in the economy really stands. As far as the markets, I think the pain trade is lower, for a period, and then a rally into the end of the year, so everybody can kind of rebalance, get their bonuses, that kind of thing. So I think you need another pullback so that there can be some profit taking for bonus, and then a rally back into the end of the year. We're almost at all-time highs in the Dow. I mean, we're less than 2%, 1.9% from previous all-time highs. You're 5%, I think, plus or minus on S&P and NASDAQ. So we're close.
Yeah, I want to show you. Let me show you guys a cool trend line. So let me bring up my charts real quick here. And this is the DIA. So this is the Dow ETF. But take a look at this trend line here. Basically comes back here, and then look, pivot high, and pivot high. And then we're right into that here. So this week, to me, per the Dow, this would be a really intriguing week on a technical basis to see if the Dow can punch through. If it can punch through, then I think, yeah, the all-time high is only, really 2% away. But the Dow has had a historic run from the lows of late October, 12%. I mean, that's a big move. People involved in crypto, Greg, I think, they're used to like 10x and stuff, but in real markets, to see 12% in a month in the stock markets, like, holy cow,
Yeah. And the young people that haven't been in the markets a long time, which is the majority of a lot of people in the, wealth management, hedge fund managers, all that, these moves we've seen in the markets, the moves we've seen in the bonds, that's not normal. No. I've been in the markets instead of crypto because of the exponential moves. They've been better in the markets than they have been in crypto, except for November.
Right.
And here's how I'm playing the whole ETF. This is my thesis and my strategy on the whole Bitcoin ETF. Is that, I'm looking for a double on Bitcoin at some point. I'm going to enter, and I'm going to enter with a huge, me, it's a huge position. I basically take everything and I go into one position at a time, in and out. So I'm looking for a double on Bitcoin, and then I'm going to pull out of that and start playing altcoins and look for 4 to 10x on a couple of altcoins that I'm watching. That's going to be my strategy for the Bitcoin ETF, because I think we're going to see that whole halving cycle bull market, scenario play out, and you're going to see a lot of things run really quick. But I'm not long-term in anything. And then I'll be back in the markets, because I think markets are going to, that whole rotation of capital with once the ETF start, I think is going to play out between crypto and the markets as well.
Yeah, I think it's going to be interesting. It shows just like generally, I think our views align, but then there's little things like that. Like I'm going to more be looking for a short when we get that approval. Like I expect what they call that God candle, the huge green candle, and I'll be looking to short into it. So, you'll be on one side, I'll be on the other side, and we'll have to reconvene in a month or so and find out what's going on.
Yeah, I'm long only. I never short. I don't do that. I'm just a long only investor, and I make big moves in and out. Nobody follow my thing. It's not the way to do it, but it's what's worked for me in real estate. It's what's worked for me in the markets during my career. But it's definitely something you don't want to do.
Nice.
It goes against all conventional wisdom and what everybody will teach you about investing.
Yeah, it's scary hearing about it, to be honest. But I mean, if it works for you, it works for you. That's awesome, buddy. So quickly before we end, let's talk about your course. It's right now. There's a holiday sale for your course. It's an incredible journey of all of your knowledge. I mean, how long have you done real estate?
I've been in the game since 1997. So, coming
Jeez,
up on what, 29, 27, 28 years now, almost 30 years.
incredible. Yeah.
Yeah,
So
hundreds of millions of dollars starting from absolutely nothing. Had no experience, no mentors. I learned, I educated myself, invested in myself, and I did it by, doing and taking action and learning the hard way. And these courses, you and I partnered, to put these together with verified investing for everybody, and all your courses have, big holiday discounts right now. And then there's one for residential, one for commercial, one for commercial multifamily. There's a real estate development course, or you can get the whole bundle, for a steal right now at $24.97. So
And I
yeah.
think, at least from an outsider's perspective, and obviously my specialty is stocks and trading, but like the key is this, is that the older I've gotten, the more I realize that a good investor does a little of everything. And so, when the time is right, I want to be able to pounce on opportunities. Like, even in my neighborhood, when you were here, there was that I mean, like literally this property with 3 different houses on it. And at the right time, at the right price, I think there's a huge opportunity there. And so by taking these courses, you have to be ready, because there'll be periods in the stock market that are great, and then it'll be dead. And there'll be periods in crypto, and we saw this, where it was dead and now it's great again. Same thing in real estate. And you have to be ready to jump on opportunity, because the money will be made in these different assets at different times.
And real estate is resetting. We're seeing a lot of distress in the commercial and multifamily sector. There's going to be more to come next year with interest rates staying higher. So there's going to be a lot of opportunities there. The residential market, is a little tricky right now in a lot of different areas, depending on what the inventory levels look like. But Florida is one of the markets where there's a lot of corrections going on. There's a lot of things happening in that market in Florida. So, for me, I made all my money in real estate, and then I started investing in markets, at the bottom of 2020, or bottom of 2000 and things like that. So that's how I diversified and, my portfolio as I went along, and I've been rotating in and out, back and forth. The key to real estate is there's huge tax advantages. So as you're making money in crypto and in stocks, you can offset those gains, or even in your W-2 income, with depreciation and bonus depreciation in real estate. So these courses teach you a lot of that, talks about all that. There's exclusive interviews with some of my one-on-one clients that I'm coaching all around the country that are doing all kinds of different things in real estate. So yeah, these things are robust, 14 hours, more than 14 hours of content, downloadable resources and spreadsheets and, all kinds of stuff to, help you get in the game and, really, really take advantage of the opportunities that are coming to real estate. And if nothing else, just to know how to invest, if you want to just do a little bit, if you want to really grow and scale, and if you just want to protect yourself and, diversify a little bit and take advantage of the tax advantages in real estate. So yeah,
It's
it's
awesome.
kind of, all your courses on sale, your courses as well. I took your courses, and, what I've learned from you, I doubled my account this year. And, like I said, I've got some big plans for what's coming up with the markets as well. So verifiedinvesting.com is where all those live.
Yeah, absolutely. All right, man. So let's conclude this, man. Let's go off and be ready for Monday's market open, and we'll see what crypto does this week. And let's make sure we reconvene in about a month and revisit all of this chatter that we've done.
Yeah, sounds good. We'll see how it plays out. Gareth, once again, it was great to see you, and I will talk to you soon.
Take care, buddy.